Macro vibe check. End of July 2026. The cost of capital is reasserting itself. Flint West reporting. The common thread is long-duration financial assets are beginning to struggle under structurally higher yields, while defense and real asset themes continue attracting capital. Section 1. Markets have a language of their own. They don't argue. They don't negotiate. They don't care what economists predict or what headlines proclaim. They vote. Every breakout, every failed rally, every sharp reversal, every exhausted trend. It's another vote. And when you line these 8 charts up side by side, something remarkable happens. You realize they aren't telling 8 different stories. They're telling one. Section 2. The first vote comes from the bond market. Treasury prices remain trapped in one of the deepest bear markets in decades. Every rally is sold. Long-duration bonds remain well below their 200-week moving average, and momentum continues to weaken. The message couldn't be much clearer. Money still demands a higher return for lending to Washington. That single vote echoes through almost every other chart. The Nasdaq 100 remains in a powerful long-term uptrend, still comfortably above its 200-week moving average. But something has changed. Momentum has rolled over. The trend isn't broken. The momentum is. The Magnificent Seven tell almost exactly the same story. Leadership is narrowing. The biggest winners are no longer climbing with the effortless confidence that defined the earlier stages of the AI boom. Even Apple, the market's bellwether for quality and resilience, has finally met resistance. The long-term trend remains intact, but after pushing to fresh highs, the stock has suffered a sharp weekly rejection. It looks less like structural damage and more like a market asking whether expectations have simply run too far ahead of reality. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Housing casts another vote. Invitation Homes has spent years proving that institutional housing could be a one-way trade. Not anymore. Lower highs, repeated failed recoveries, and trading below its long-term moving average all point toward the same conclusion. Carry matters again. Speculation casts its vote next. Hyperliquid enjoyed a beautiful uptrend into June. Since then, the pattern has changed. Lower highs, price slipping beneath its moving average, momentum fading toward oversold territory. Risk appetite is becoming more selective. Then come the strategic materials. MP Materials experienced an explosive rally on extraordinary volume before suffering a violent correction. But the chart doesn't suggest the rare earth story is over. It suggests something much simpler. Nothing is wrong with the strategic thesis. Everything is wrong with paying any price. Finally, there is one chart that refuses to follow the others. The U.S. Global Jets ETF continues making higher highs and higher lows, breaking into fresh cycle highs with healthy momentum still intact. Unlike many of the other charts, this one isn't being carried primarily by falling discount rates or expanding valuation multiples. It reflects something tangible: commercial aviation, aerospace demand, industrial activity, and a world becoming increasingly focused on defense. Aviation is back. Section 4. Taken together, these charts reveal a market rotating away from duration, multiple expansion, and speculative growth toward a world where financing costs matter once again. As long-term yields remain elevated, long-duration equities face valuation pressure. Housing faces financing pressure. Speculative assets lose liquidity. Capital becomes increasingly selective. Cash flows begin to matter more than narratives. Viewed individually, these are simply charts. Viewed together, they become something much more valuable. They become a snapshot of an economy moving away from liquidity-driven valuation expansion and back toward capital allocation governed by the actual cost of money. And if these charts are right, the cost of capital isn't just rising, it's reasserting itself. Flint West signing off.